Good morning, everybody. So the PDF is still down. I think they changed a vast majority of the book because that book's been out, or the PDF's been out since October 3rd, October 7th. They pulled that last week. Usually they just make adjustments. The 4012 is 4012A is the adjustments, and the 4491X has its own adjustments, but they pulled the full thing. Just so you know, we start in November with our training, but majority of VITAs in the country start in January. So we are early, but our normal flow is back probably about 2-3 weeks. They announced that in the webinar from last week that they are behind. As far as our grant goes, we will get the grant. They haven't announced the amount yet. So hopefully that gets pushing, but most likely we'll have our books by December.
Are we going to get paid?
Right?
Same as last year.
They still say we're on track for tax layer and everything to be up and ready starting after the 15th. That's when to expect the test and everything to be available. But that's usually open sometime after Thanksgiving. So they're giving hope, but the 15th is early. So hopefully when that is all up and ready to run, I'll send that out. It's just a matter of being patient so they figure out what they got going on. And that's about it. So I'm about to log in to send out the PowerPoint now.
Okay.
Is that? And here's Jared.
All right, good morning, everyone. How's everyone feeling this tax season? All right, so we got the good news. Government's going to be back up and running here, and unfortunately no raises this year, John, but hopefully everyone's ready to go here. Out of curiosity, how many of you are brand new first-time preparers here? Okay, wonderful. That's fantastic. So we're going to cover a couple things over today and the next couple training sessions to talk a little bit about a lot of the introduction to tax preparation. We're going to break our sessions down. We're going to talk a little bit today about filing status and dependency. Good news is this didn't change from last year. Bad news is about the only thing that didn't change from prior years. So for those of you who are brand new, don't worry about it. We'll teach you all the new things. We're going to talk about a couple of the tax changes that have occurred. One of the reasons why Edward mentioned that the 4012 is down, it actually was not entirely accurate when it was up, so that's probably a good thing it's not available. Good thing for us is that I actually am teaching this material currently, so we'll give you the latest information here with our presentation. I actually have students up at E-Town right now. We are actually doing a little bit of the practice lab in the 2025 version. So I use them as our guinea pigs to figure out what's right and what's wrong in the program. So hopefully we'll isolate a few of those incidents and be able to bring those to your attention as you're preparing for your certification tests and everything else. So just want to go through a couple things here for you today. Again, this session is going to be designed to talk about our filing status and dependence. And then we'll be talking about income next week, including some new changes to how some items of income are going to be taxed. And then we'll get into some more deductions and credits in the following week. So I think we're all set and ready to go here with the recording. And we'll go ahead and get our presentation going. All right. So good news is that April 15th is our actual deadline this year. No Patriots Day to worry about or holidays, so we don't have those extended days to worry about. Every year I've come up and said, oh, no significant tax law changes for the past couple years. At one point, I realized I would be eating my words, and that is this year. We had a very significant tax law change for the first time since about 2017, just back in the summer of 2025. So we're going to be talking about a couple of these new tax law changes throughout the course of the program. Where we see a lot of applicability for our VITA clients is going to be in the areas of taking a look at the Standard deduction has changed. That's going to be an automatic process. So I'll update the rates. That's one of the reasons the 4012 was out of date. Tax brackets are exactly the same. For VITA, we're pretty much going to be staying in those same areas, not more than probably about 10, 12, or 15%. But the tax brackets are identical to where they have been in the past. But we have some new temporary deductions that I'll be covering a little bit later on this process. So one of those big ones, people are probably already hearing about the no tax on tips. Great phraseology. That's not exactly how it works. So we'll talk about what that means for the excludability of tip income, which really is going to turn out to be a deduction. Same thing when they talk about no tax on overtime. That will also be a deduction that I'll be mentioning at our next session. So those are our two big ones we're going to see. The downside is trying to make sure that the payroll reporting is going to be ready in time for tax season. From our understanding, there will be no changes to the W-2, so we have to figure out how that information will be reported effectively so we can put that into the tax returns. Another big one we hear is the no tax on Social Security. Again, great soundbite, but doesn't actually work. What instead we have is going to be a new deduction for seniors age 65 and above. So we'll also mention that one when we talk about deductions. The other one that could have applicability, although I don't think quite as much here at VITA, is going to be the new car loan interest deduction. I've had some people come up and say, oh, I decided to buy a new car because I get to write it off. It's like, that's not how it works. But if you want to take advantage of car loan interest deduction, that's going to be available as well. We're going to see a couple things fall off after this year, including some of those energy credit provisions. So some of those are going to be changing. As always, tax law, hold on tight. We don't know what's going to happen next. So it's always a moving target. But we do see another increase here. The child tax credit's actually gone up to $2,200. So I believe in all the years that I've been presenting, I don't think we've had more than 2 years in a row where the child tax credit's been the exact same amount in the exact same positions. So we always say don't memorize anything because all these things will change. So I just want to give you a quick overview of what's going to happen in the next couple weeks as we talk about some items of deduction and credit. So most likely our third week here, which will be right after Thanksgiving, everyone's going to be well fed. We don't have to worry about getting together for pumpkin pie or anything like that. We'll talk about that right afterwards and talk about a lot of these new changes that'll be impacting our tax preparation for the current year. So the good news is that basically a lot of the things we've talked about before in this session are going to be the similar concept. We won't really have many changes in filing status or dependency. Those rules haven't changed, but I want to just do a quick refresh for everyone about where we're at. First thing I want to take a look at, we do have our slides. In the corner, you'll see what is expected to be where it's going to be found in the 4012. I had used the version that was pulled down, so I'm hoping they're going to still be there when they revise the 4012, but it should be fairly close. So the one thing we always talk about first, one of the questions you're going to find on your certification exam is who must file return. And the interesting part about the filing concept is it's based on a number of factors. How much gross income you have, your age, and your filing status, which is great because we talked about none of those items yet at all. Age is pretty easy. We get that one, and the only time you ever have to ask is the first time we do the return. But that'll be updated in the system. What we're taking a look at is the who must file question on your certification is dependent upon how much income someone has and whether or not they exceed the standard deduction. Now, the standard deduction is allowable for all taxpayers based on their filing status. So the chart that's up on the screen is the latest one we have for 2025. I'm sorry. As I was saying, the chart that's gloriously behind me now is going to go ahead and detail some filing status opportunities, as well as what the current standard deduction would be. So as you notice, we still have the same 5 filing status as we've had in the past. We want to start with the single individual. We'll go through a little bit more detail as to what that will actually entail in terms of the definition. But when we take a look at the single individual, as long as they're under the age of 65, they have the first $15,750 of income will be excluded. Effectively, it's going to be a deduction. So if they don't make more than $15,750, they do not actually have to file an income tax return. If they're age 65 or older, we actually get an additional $2,000. So that's up to $17,750. Yes, excellent news. Good news is you don't have to memorize any of this. You don't have to enter this anywhere. This is already built into the TaxSlayer system. So as long as you pick the filing status and you enter the date of birth, it will automatically calculate the standard deduction. Once we get to the married, what we're going to see is that's actually twice the amount of the standard. So we talk about concepts of marriage penalty. For a deduction perspective, you get the exact amount for each individual. So it's going to go up to $31,500, the highest it's been. Now, when you're 65 or older, we don't get quite the $2,000. That's where we see a little bit of a change. So you'll see the amounts up here, $33,100 if only one of the spouses is 65 or older. If both would be, we're now up to $34,700 a couple can earn without having to file an income tax. This is only for the fact that if they have income of less than $34,700, they will have no tax liability. There'll be a couple special exceptions I'll talk about in just a minute. Married filing separately, all the way down to $5. So we'll talk about married filing separately, why it is not the most favored filing status. Head of household, this is actually going to be one we talk about quite a bit, where people like to go with the head of household if they qualify. Again, it's a great filing status. The benefit they have is a higher standard deduction, and that's one of the main benefits they're going to see from the head of household. If they're under 65, it's going to be $23,625. If they're going to be older, 65 or older, it's going to be up, again, the $2,000 additional amount, so $25,625. The one that we don't see very often, but the most powerful filing status, is the qualified surviving spouse. That is basically the same rates we have for the married filing jointly. So we'll talk about that special status, but it's going to be the exact same. But again, we only need to take a look at our age. Again, already part of the process. We'll talk a little bit more about the appropriate filing status for the taxpayer on the return, and then the gross income, which will be automatically calculated. As you're taking this certification exam, they'll be asking you whether or not someone may need to file a return. So now we may take a look. If you have an individual who comes in, 34 years of age, they made $15,000 of wage income last year. Would they technically need to file a return? They would not. They probably should, but they don't need to file a return. Same way if we have a married couple that are 65 or older, combined income, they have $40,000. Would they need to file? Yes. Hopefully we're good with that. So those are the things we take a look at here. There are a number of areas that we should file. So even though this is our basic background, it's going to be based on our age, filing status, and age or income, there are some situations where who must file. And that's going to be if you have any special type of taxes. The biggest one we're probably going to see here in VITA is anyone who's participating in the marketplace. If they have health insurance coming through either Penny or the marketplace, again, that's been in the news maybe just a little bit over the past couple weeks about marketplace insurance. You're going to see that we're in that renewal period now for insurance. That is going to be one of our biggest ones. If they get a Form 1095A, they need to file a return. One of my biggest issues when I file returns, why I'm getting reject notices, is because a client failed to let me know that they were getting insurance from the marketplace. So that's going to be a big one here. If they get a Form 1095A, they need to file a return. We also have some unique situations where if children are part of that process, there may be a workaround we have to do. But if they have income or health insurance from the marketplace, they need to file a return. Some other situations may be if they have self-employment income. We'll talk about that a little bit in our next section about what self-employment income is. But predominantly here for VITA, it might be people who are doing maybe DoorDash or Uber or Lyft drivers, people that might have a side job. If they have more than $400 of earnings, they would be required to file a return. Likewise, if they have a distribution from a retirement plan, and that is considered an early withdrawal, that's going to be a mandatory requirement for filing as well. The last one we have, and hopefully, I believe we should be done with these at this point, is the first-time homebuyer credit that had occurred many years ago. That's a repayment that occurs. I believe we're at the final years for these individuals, but there could be some other repayments that they have based on the IRS system. So now everything that I just talked about is now in a wonderful black and white and bolded red. Obviously, we're trying to call out your attention to the ones that are most appropriate, which will be that Form 1095A. Okay, so we have the who needs to file, who must file, and then we get to the who should file. There we go. All right, wonderful. Now it's working. So who should file? Everybody, right? We have room for almost everyone to come into the VITA sites. One of the interesting parts, I think what we're going to see is with all these new tax law changes, there may be more of a demand for our services than ever before. Taxes were supposed to become simple. Years ago, they had mentioned about making these so simple you could do them on a postcard. If you've seen the 1040, it is the world's largest postcard with multiple pages. So we've gone well beyond that. So I think what we have is some people may have become comfortable that they can file these returns on their own, maybe now looking for additional assistance. So it's great that you're back here volunteering for VITA, because I think we'll see a lot of demand for our services. So we're going to see people come in that may not really have much of a filing issue, but they just want assurance that someone else is taking a look at their return. Who should file? Pretty much everybody. But they need to file a return if they've had withholding. In order to get a refund from the IRS, you need to file a return to request one. The IRS does not automatically just start handing out money to people they think should get it. You need to file a return in order to get your refund. So that would be for anyone who's had any taxes withheld, predominantly through wages, maybe from a distribution from a retirement plan. So they'll need to go ahead and file the return. If you had a transaction, so if you're selling stocks, bonds, anything where you're getting a 1099-B from a broker, mutual fund, something along those lines, every once in a while we'll see what is called a 1099-S. That's also a sale document. That's generally for the sale of real property. If the settlement agent knows it's your personal residence, you shouldn't get one. But if you do get one, we need to file a return. We should file a return and make sure the government doesn't want extra money from you. But the biggest thing we also have, in addition to getting the refund based on withholding, is the clients are most likely going to be eligible for credits. The biggest ones, the one that's going to be consistent here, is the earned income credit. We'll have the additional child tax credit. That's also a refundable credit. The American Opportunity Credit. We should be outside the recovery rebate credit at this point. I think most of those have all been settled. Although if you go on the internet, someone's going to tell you the government's going to send money out at any time for you here. So we'll help you answer those questions by tax season as people are getting their famed tax advice from Reddit or I don't know, TikTok at this point, whoever's giving tax advice. We'll make sure that you have all the factual information when someone comes in. Another big one we see, and I believe you may have already heard the conversation about state taxes, is the PA property tax rent rebate for seniors. So we actually have a number of sites that the only reason people are coming in is for the assistance with the PA 1000. So we'll continue to see that here. The amounts are still very popular for seniors, so that is going to be another area we want to see. We can file returns even if there's no income at all on the federal side. There's a process. The 4012 should be able to outline that for those who've been site coordinators. I think the workaround is to put $1 in as income. There's a special place in TaxSlayer that you can put $1 of income in just in order to e-file a return, and it will not throw off the calculation. Give you an idea, $1 is not going to hopefully cause a tax liability for anyone. So there are ways we can actually still e-file a return even if they do not have any taxable income. Okay, so the next thing we want to also make sure you have is the mailing address on the tax returns. So we always want to make sure we have the most current address. So if someone comes in and they're getting the returns done in March, but they had lived somewhere else for all of 2025, it doesn't really matter where they had lived. We're making sure that the IRS has the most current address on file. So whenever you have someone come in, even though their documents may say something else, we want to be sure the address on the 1040 is their most current mailing address. That way, that will make sure that any future correspondence goes directly to their new address, not to an old location. There's a bit of a little trick with the earned income tax for the local we have to make sure that we're using the exact addresses they had where they lived. Again, that's only if they have earned income tax, and we can take a look at that again if you have any questions specifically on local returns. Now getting into a little bit more of the substantial nature, dependency. So one of the areas we're going to take a look at today, as I mentioned, filing status, which we'll cover right after dependency. But dependency is a big issue of determining who else can I claim on my return. So there are a couple rules I just want to make sure we're good on here for this process. But when taking a look at who can be claimed on a return, there are a couple rules we have to take a look at here. Again, hopefully we'll be on the C3. I'm assuming that's not going to change during the revamp here, the 4012. But a couple rules we have to keep in mind. You can only claim a dependent on your return if you yourself are not a dependent of someone else. Now, we're going to mention a couple rules here, and some of these seem fairly obvious. But if you're dependent upon someone else, no one else can be dependent upon you, if that makes sense. There will be a couple rules we'll take a look at. Where this may arise is you may have a situation where you have a parent who has a child, but that parent's living with their own parents. So if they're not employed, if they're being supported by their parent, they might not be able to claim themselves. So they obviously can't take their own child as a dependent on their return. We'll explain that process. There's probably another way around that. But the person being claimed as a dependent has to meet a couple eligibility rules. And they're fairly broad. The individual that we're going to take as a dependent has to be either first unmarried, and then here's the fun part about taxation. We'll give you a rule, then we'll give you an exception to the rule, and then potentially an exception to that exception. So the first thing we take a look at is in order to claim a dependent, that dependent cannot be married. Maybe. So they can be married as long as they don't file a joint return. But they can be married, they can file a joint return if the only reason to file a joint return is to get a refund. We're going to try and make this as broad as possible. I don't want to, especially for the brand new ones, I don't want you to come in and like, oh my gosh, how many rules do I need to memorize? It's going to be a little bit more clear as we get into the site. We're probably not going to have anyone who comes in and says, I'd like to claim my child. Great, let's go take a look at the rules. Well, my child happens to be married. Okay, I remember that's a problem. Are they filing joint return? Yes. Okay, that might be a problem. Are they filing just to get a refund? Yes. Okay, now not a problem. Don't worry about that. We have decision trees inside your materials, and we rarely will run into these odd issues. Again, I just want to mention, if we have any unique circumstances, it is okay to hold on to that return. As John mentioned, we're not making all this money just to get these returns out quickly. We want to make sure the returns are getting out as accurately as possible. So if there are questions, by all means, let's hold on to that return and make sure we have it going out as complete as possible. So they're getting their work done for free. So we'll make sure that it's done accurately, but it may take a little bit more time. If they want something fast, there's usually probably a Statue of Liberty sitting in the middle of King Street that they can go to and pay a handsome reward to go ahead and get anything they want done on their return. That's not what the VITA program is about. But basically, general rule for dependency, the individual you're claiming will generally not be married. We have not many situations that would occur. However, we do want to make sure that they are going to be, oh, I'm sorry, do you have a question? Yes?
If a dependent has met the threshold, they can file, still be a dependent, correct?
They can still file a return if they're being claimed as a dependent. There's a special check mark you want to have that they are not going to be able to take their own dependents. So a dependent may file their own return, and we see this quite a bit. So if a child's being claimed by their parent on the return, the child will still need to file a return. They just aren't going to get the same benefits. They can't take any dependents themselves, and we have to make sure that there's a check mark that goes through on that return. So it's going to be a very critical one. Hopefully we prepare returns for the parent and the child at the same time. The biggest thing we run into are college students that get really excited about filing a return, and they send their return off, and then months later their parents file, and the parents get a reject notice because the child forgot to mention that they're a dependent on that return. So we do want to watch that. Particularly, it's a great point if we see someone coming in early. If you see a younger individual come in and they happen to be a college student, maybe you're at a site that's close to Millersville or Franklin and Marshall, and they come in and want the return done, we probably want to double check before we submit that return that we have that dependent of another box checked under their information. So very critical, because otherwise the government's going to reject the second return because they've already been claimed on a different return. So it's a good point there. In terms of residency, the individual has to be either a U.S. citizen, U.S. resident, U.S. national, or a resident of Mexico or Canada. There are some special occasions with adoptions. So if adoption's in process, we don't have to meet these exact same rules, but we do just have to make sure that they are eligible for dependency. Again, not much of an issue we have within the VITA program itself. I just want to make sure you're aware of all the rules when it comes to your certification exam. Certification test may be asking you a couple of these questions. If they're a resident of the U.S., Mexico, or Canada, we should be in good shape to claim that individual as a dependent. And then we're going to get into what category will they fall into. There's only two different categories: qualifying child and qualifying relative. And I'm going to warn you, particularly those who are brand new, take whatever English definition you have of child and relative and throw it out the window. We're going to use child in the tax code about 13 different ways and describe various elements. So we're going to talk about a qualifying child for dependency purposes. We're going to talk about a child for purposes of the child and dependent care credit. We'll talk about the child tax credit. All of these have different definition. And I won't really get into too much of it here, but we also cover a concept called kiddie tax, which sounds like it should be a child, but it's not. So just give you a little bit of forewarning here on some of these definitions, which is why I want to make sure we're fairly clear on what we're looking at. All right, let's start with the qualifying child. Okay, let me get a breath here before we get into what a qualifying child is. Usually I will start off with teaching this concept to say, just in your own mind, just picture what you kind of picture as a child, right? What would we imagine a child to be? Kind of a relationship, it's an offspring. You're probably thinking of a certain age of an individual. Usually my students will say, I'm thinking probably someone 12 or 13. Yeah, we're okay. But we're going to talk about this a little bit more. So a qualifying child under the IRS's rule first has to have a relationship test. So that individual has to be either the taxpayer's child, great, son, daughter, we're good, stepchild, also pretty good so far. I think we're in the normal category. Then all of a sudden we hit brother or sister right away. And this is where we kind of get out of the traditional family tree biological definition of a child and get into the IRS's definition of a child. So we're not only including the child, the stepchild, we're also going to include a brother or sister, half-brother, half-sister, stepbrother, stepsister, or descendant of any of them. Which means we're talking about your grandchild can actually be considered a qualifying child because they're going to be a descendant of your own child. Your nieces and nephews could be considered your child, because they are the offspring of your brother or sister. So we have a fairly robust system of what can be considered a qualifying child. And there's a reason why it happens. The IRS has envisioned many different scenarios in which someone may be taking care of an individual. And as long as we meet the definition of child, the relationship test, we should be okay. So that does include adopted children. It does include foster children as well. So we have a fairly broad category. And why we mention brothers or sisters is we may have a situation where someone is taking care of their siblings. There may not be parents in the picture, and we have an older child who's taking care of younger children in the household. They're able to take those children under the relationship test. So technically, while they're not their biological child, they still meet the definition of child for IRS purposes. So that's our first test, relationship test. It is fairly broad. It's basically taking a look at you, your siblings, and anyone descendant upon them. So it's a fairly broad chain. Next, we take a look at the age test. So they either have to be under the age of 19. Okay, so we're basically saying 18 or under. We're also saying a full-time student under age 24. And now we get to take a look at definitions. Full-time, when people ask full-time, they probably think year-round, probably close to 40 hours a week. Not so. What we mean by a full-time college student is that at any point of any 5 months of the year, they were considered at least half-time of a student. So that basically means that they have a workload acceptable for the college, that they are considered at least a half-time student. And when we talk about any part of any 5 months, It's basically designed to follow the semester systems at most colleges. So here in the fall semester, most students will actually come onto campus in August. They'll have August, September, October, November, and then maybe 5 days in December. That's any part of 5 months. That's still considered a full-time student. Same thing in the spring semester. Generally, we'll start in January, February, March, April, and generally graduate in May. They don't have to be full months. It is any part of any month as long as we hit 5. So generally, either semester that they're attending, they can be considered a full-time student as long as you're under the age of 24. We also have another category. So if a child is considered disabled, they can be any age. So there's no age restriction if they're considered disabled on a permanent basis. They also have to have a residence test. So they have to live with the taxpayer for more than half the year. So this really helps us define who can actually claim a child. They have to be with the taxpayer for more than half the year. I'll go through a special exception here for non-custodial parents, but I just want to make you aware of that for the rule purposes. But generally have to be in the same household of that child for more than half the year. Temporary absences aren't going to count against that. So we just mentioned college students. If they're away at college for the full year, they're still considered living at home. That's a temporary absence. So things like education, if they're away for vocational purposes, if they're incarcerated, they actually use vacation as an example. I don't think we've ever seen anyone in VITA who says, my child has been on a vacation for the last 10 months. Can I still claim them? Yes, you could, but I don't know why they're on vacation for 10 months. That seems like an excessive amount of time. But temporary absences aren't going to count against you. The rule is that the child cannot provide more than half their support. So it means the child is not actually providing more than half the cost of food, clothing, and shelter. That's what we basically mean by support. Does that mean the child can't work? It does not mean that. The child can work. If the child works and makes significant money, but saves their money for future purposes, that's not considered as their support. So we're basically looking, is the child actually providing contributions toward the household? Is the child effectively providing for more than half their own care? That would be an exclusionary topic. Now, again, oh, yes, sorry, yes, sir.
Tuition.
Tuition is not considered support, so that's actually outside. So we're basically looking at kind of food, clothing, and shelter is kind of our main process there for the support characteristics. Yep, great question. The other thing we want to take a look at is people ask, okay, how do I be sure the client's giving me the right information? That's always a big question we have. We basically have to take their word on what they're telling us. If it seems reasonable, we're okay with it. You may want to ask a question and find out what the response is, maybe rephrase the question a little bit and see if you get the same response back. But we're generally going to trust our clients. Again, we are basically under the auspices of the IRS. The clients know that, or hopefully know that we're going to follow the IRS prescribed rules. I don't think we've seen many instances where people are trying to come in to get returns done, that there's anything that is not something we feel comfortable with. But we basically take their word. The IRS is not going to go ahead and come in and ask for documentation unless we have an issue. We always remind taxpayers that they're responsible for maintaining their own documents. In case there's an inquiry, the IRS is going to take a look at their activity, and so they just need to substantiate their responses. Again, we mentioned the child cannot file a joint return, except they're filing a joint return only to get a refund. We typically don't see that here in this area. That might be individuals who, the most common example is where you have people who are marrying someone out of high school and that spouse is going off to the military. We see that a little bit more in more active military areas where you have someone who's going to marry their spouse before they're off for active duty, but they end up maybe still living at home, or they're not completely on their own. They can still be dependent of their parents because they're not providing more than half their support. They're filing a joint return with their spouse only to get a refund. That's acceptable. Not widespread, but I just want to mention all the permutations the IRS has. So just to give you that information. They also cannot be a qualifying child of another taxpayer. And we'll have some tie-breaking rules we're going to go through. Because as we take a look at the relationship tests, as we take a look at a couple of these other things, multiple people could actually claim a child. If you're all living in the same household, if you have 3 generations under the same roof, The parent had the opportunity, the grandparent would have an opportunity, aunts and uncles could have an opportunity, a brother or sister could have an opportunity. So we want to take a look at the tie-breaking rules to make sure that individuals are in good shape. Yes, sir.
Some people have a child who's in a stable living situation, but the parents are divorced, and they take turns. One year,
Yep.
one gets them, the other year, the other gets them, even though the child doesn't move.
Yes.
That go with number 2.
Yes. Well, it's a great question. I'll repeat the question. So the question is, child's in a stable living environment, but they have parents who are no longer married or not living together, and the parents may alternate taking the child as a dependent. The IRS rule is that a non-custodial parent can claim a child. The tie-breaking rules we'll take a look at in just a second. Generally, the IRS will favor the custodial parent. If there's a question where more than one parent has claimed, it'll generally go to the custodial parent. Oftentimes, there may be an agreement between the parents that they will alternate. As long as only one claims, the IRS is going to basically allow that to happen. Where we have a situation would be if we have multiple parents claiming the same child. That's where we run into an issue. And there's 2 ways around that. One is as long as they have that verbal agreement and they say, well, in odd years I take this child, and even years my spouse or former spouse will take them. We also have a agreement. So typically a divorce agreement may say, here's how it's going to be divided. The IRS will not recognize a divorce agreement. That's not going to be their method. They need to have a form that's signed. It's called a Form 8332. So hopefully that's signed at the same time of divorce. If that is filed, it's basically both parties agreeing in writing with the IRS that who's going to claim the child in those years. That's technically the only form that's going to give the non-custodial parent the right over where the child's lived for more than half the year. So if you have any client who is going through a divorce, you may want to suggest that they have their Form 8332 filled out. Most divorce attorneys should be aware of that form and should have that as part of the agreement. Otherwise, we're hoping that the other party's just going to rely on that verbal agreement and they're not going to try and claim the child. Again, we probably don't want to offer advice to the custodial parent to say, I know you agreed, but you really don't have to, because you can actually go ahead and claim. But we are going to take a look here at some of these rules on what happens when we have a multiple child scenario, how the tie-breaking rules will come in. So again, as I mentioned about the the support issue, it's only if the child provides more than half their own support. If the child's going to receive SSA, if they're going to get some sort of benefit from the Social Security Administration and uses that for their own support, that would count. And we have to determine whether or not they paid more than half. But generally, support from the state or other agencies is not considered support provided by the child. We don't care who actually provided the support as long as the child did not provide more than half their support. I don't think we run into most of those cases here in VITA. Generally, the child, if they're getting some sort of support, will not be considered as doing it on their own. It's going to be considered as coming from another source. And again, it doesn't really matter who provides it as long as the child doesn't provide more than half. Now, getting into the question about the tie-breaking rules. There we go. Okay. So I'll give you the chart. I'll just kind of explain a couple of the areas here. So generally what's going to happen is if more than one person tries to claim the child as a qualifying child, the individual who's going to have priority is the parent. So if you have multiple people trying to claim, a grandparent, an aunt, an uncle, or the parent's going to get the top priority. That's the way the IRS tie-breaking rules will work. The situation where we have, if both parents try to claim, and the IRS has to put in here, as long as they're not filing together, I still don't understand who had the question. They were married, we're filing together, which spouse can claim the child? It's on the same return. Please don't waste IRS time by asking which parent gets to claim it when it's on the same return. But yet they have to feel the need to go ahead and delineate that in the instructions. If you're filing a joint return, it doesn't matter. It's going to go in the same return. But if you have parents who are not married or not filing a joint return, then this is where we go back to that situation of the custodial parent. Where did the child spend the majority of their time? And that could be a situation where you mentioned about that stable living environment. A child's in school. The parents don't want to uproot the child from that school. The parent may be spending more time at one parent's house, maybe weekends or maybe time over the summer with the other. One parent probably has a greater amount of custody over a child. Under the IRS's rules, that would be the parent who wins. So even if we have a verbal agreement to say we'll alternate years, if both parents try to claim, it's going to go to the custodial parent unless we have that Form 8332. That's going to override that presumption of custodial issues. If both parents claim and they both have the child for the exact same amount of time, which is very rare to occur, but it could happen, maybe alternate weeks with the child, then the IRS is going to go to the rule of whoever has the highest adjusted gross income. And again, I love giving you things of rules where we haven't defined what income is or adjusted gross income, but we'll get to that concept. I just want you to know how the IRS is going to tie break here. So both parents try and claim, general rule, whoever had the child for the most amount of time. Both parents had it for the same amount of time, it would go to whoever has the highest amount of income. If no parent can claim the child, maybe both parents are out of the picture, you may have a grandparent or an aunt or uncle trying to claim, it's going to go to the individual with the highest amount of income. Now, the last scenario is a bit unique. This could be where a parent could claim the child, but they don't do so. This could be a situation where maybe you have a parent who is, their income's not sufficient enough to actually file a return. Maybe they're not going to get the benefit of a child tax credit, so they choose not to claim the child on their return. Someone else could, as long as that individual has a higher amount of gross income than the parent would. So I just want to show you the rules, mainly for certification purposes. We don't typically run into this. When I had done some work with VITA, we had a situation where we had a whole family group come in at one time, which was great because we have about 4 tables all working together, preparing a return and trying to figure out under the living situation, where should these child, where would they be best? But we don't often run into those scenarios. Usually it's more of a clear-cut case. But I just want to talk about a little bit more of the rules about tie breaking. One other one I just want to mention here, again, kind of following up on that non-custodial parent issue. Hopefully, again, this will be on C8 once we have the updated 4012. Whoever claims a child gets a certain amount of tax benefits. So we have 6 different benefits that they can take a look at. One is a credit for other dependents, the child tax credit. They're pretty much hand in hand. That would also enable head of household status if they're claiming a child, earned income credit, the credit for child and dependent care credits, and also any exclusion for dependent care benefits. Now, again, as I mentioned, the non-custodial parent can still claim the child. So 2 ways. One is the custodial chooses not to do so, and as long as the IRS only sees one dependency going through, they're not going to really question whether or not who actually had custody. But the way to perfect that interest is to make sure you have that Form 8332 signed. Or if you have a divorce decree before 2008, so we're going back quite a bit of time here, that's the only divorce decree that's going to override the IRS's presumption. Now, the non-custodial parent can still technically claim the child under these rules, that they're going to go ahead and file the 8332 or they have an agreement, which allows them to actually take the child tax credit and the education benefits. The custodial parent is still actually eligible to take things even if the child's not on their return as a dependent. The custodial parent still actually can do the head of household status. They can still claim earned income credit. They can take the child and dependent care credit, because the child and dependent care credit, which we'll talk about in a couple of weeks, is only for the parent who has custody. A non-custodial parent technically should not be taking the child and dependent care credit. Again, the question is, will the IRS know if they're a custodian or not? It depends if we have multiple people. Yeah, John.
If you have an unmarried couple, a couple of kids, can you slice and dice?
Absolutely. Yep. So the question being, if we have parents who are not married and they have children, can we rotate those? For absolutely. And so what I will do in practice is I'll actually take a look at their benefits. Obviously, there may be some things based on income with the child tax credit or other benefits be appropriate for individuals. We're going to talk about filing status in a little bit. So generally, we can't do that to try and get head of household status in the same household, but we can actually move those around to try and maximize tax benefit. So if you have 2 individuals not married and they have 3 children between them, you can do all 3, 2 and 1, 1 and 2, 0 and 3, whatever combination you want, as long as they meet these other rules. Yep, so you can absolutely go ahead and modify those. Okay, how are we feeling before I move on about children? Okay. I told you it's going to be confusing with these definitions. It's going to get even more unique as we go through. Okay, so I just want to kind of mention the child aspect here. The next one I want to talk about is qualifying relative, which I'm not a huge fan of this definition either, because I would rather the government call this other dependents. Because what we're going to take a look at is a qualifying relative. Remember we talked about a child is being your brother or sister, or your nieces and nephews. I don't know that most people would automatically assume that you're going to call your niece and nephew your child. But under the IRS rules, they could be. But a qualifying relative is going to be even a broader concept. This is kind of unique of how the family tree is going to work. Now, in order to get to the qualifying relative test, they cannot be a qualifying child. We go qualifying child test first. And if they're not a qualifying child, then we move over to the qualifying relative test. Now, the very first one I'm going to talk about here is they don't even need to be related to you, but we call it qualifying relative. If that individual has been with you for the entire year as a member of your household, they can be considered a qualifying relative and eligible for a dependency exemption. Now, there are a lot more caveats. I'll talk about some rules here about their amount of income they can earn and a few other things. But they don't even have to be related. So, again, I'm not entirely thrilled with the definition of qualifying relative if the first definition is not even related. But then let's take a look at the relation aspect. Okay, so, probably should have grabbed some water here. The relation aspect. Again, let's go back. Child, stepchild, eligible foster child, grandchild, great-grandchild, brother, sister, half-brother, half-sister, stepbrother, stepsister, father, mother, grandparent, other direct ancestor. So we're going up your family tree, down your family tree. It does not include a foster parent. That was a special carve out there. It includes your stepfather, stepmother, niece, nephew, aunt, uncle, brother-in-law, sister-in-law, father-in-law, mother-in-law, son-in-law, daughter-in-law, or anyone else who's ever met these people, effectively. It is by blood, by marriage. If you're going on your ancestry tree and they're on there, they generally count. There is one very odd carve-out. Cousins do not fall under this whole process. So no matter how we kind of divide this tree up, cousins are not considered a qualifying relative. So if you have a cousin you're very close to, make sure they're living with you all year long and we can fit them in a different way. But the qualifying relative, the reason why we generally see this test might be in VITA that we have an individual claiming their parent as a dependent. This is the way we get there. So it doesn't have to be a qualifying child. It could be a qualifying relative. You could be caring for an aunt or an uncle or a parent. So that can be considered in this element as well. But the biggest one is their gross income. The gross income test in this scenario has to be less than $5,200. So that means the individual that you're going to claim as a dependent is not having significant income. So generally for a parent, it might be that they're in a retirement community or they're having some assistance and they don't have sufficient taxable income. If you have someone living on your couch all year long, again, as a reminder, they have to be there from the very first day of the year. January 1, they've come over for some pork and sauerkraut and watching the bowl games on TV. Keep them there until the ball drops for New Year's Eve the next year. Don't let them leave. You know, they get here and they're like, well, I've been living with you for 11 and a half months and now I think it's time to get my own place. You're like, that'd be great after December 31. I need you here for the entire time and make sure I have your social security number. Also, make sure they're not making more than $5,200. We're going to get to the point in time where you're going to see the ads for looking for seasonal help around the holidays. A driver to help with deliveries or maybe some people working retail. Don't let them do that. If they make more than $5,200, they're no longer going to be a dependent. So if you want to try and keep them as a dependency, make sure they're with you all year. They don't make more than $5,200. The other thing that we take a look at is we talked about that support test. For a child, the child was just taking a look whether or not they provided more than half their support. It didn't really matter where it came from. You could have a child you're claiming as a dependent, but you're living with a grandparent, and the grandparent pays for everything. That's fine. You can still claim the child. In this case, in order to take another relative or qualifying relative, you have to be the one providing more than half the support. So it's a little bit of a change of how we take a look at that definition. It makes sense because if you're going to claim someone as a dependent, you should be providing their support. And that's what we're taking a look at with this definition. So we're looking at the gross income. It does not include state benefits or income from sheltered workshops. So generally, we may still see people qualify even if they have some additional income. Now, gross income for this definition of that $5,200 is any form of money, property, or services that's not exempt from tax. So if they're getting any type of benefit, it's generally presumed to be taxable unless there's an exception in the tax code. Certain things are going to be like scholarships, inheritances, gifts. Those are not considered taxable activity. Social Security is kind of our big one. If we try and claim a parent and we say, well, they're make more than $5,200 in Social Security, that's fine. But how much of their Social Security is taxable? We're effectively looking at their taxable amount of Social Security. So on C3 of your 4012, it'll go through a little bit more of a definition of how we calculate whether or not Social Security is going to be considered gross income. Generally, it doesn't count unless you're filing separately or if half the benefit plus other gross income exceeds $25,000. So that's kind of our back of the napkin approach. $25,000 is kind of our threshold to say if half the benefits plus other income exceeds $25,000. So in most cases, if you're going to claim a parent, they're probably not going to be in that situation. And there are some examples, not just in the 4012, but also the 4491 is a great appendum to our materials and goes through some more practical examples. So generally, most people will have an idea of dependency. Again, each year is going to stand on its own, though. So just because they did it last year doesn't mean they can do it again this year. So we always want to caution they may bring in a prior year return or maybe they came into the site before. We always just want to make sure that we take a look at the rules this year, make sure that they can still qualify as needed for these activities. Okay, how are we feeling on dependency so far? Okay, and I'm thinking we may want to, Edward, how are we feeling? Do we want to take a quick break or do we want to continue? Okay. I don't want to lose any new people, so we're going to block the exits for anyone who thinks they're a little overwhelmed. I promise you we will get to a little bit more of a situation where it's going to be a little clearer. I do apologize because a lot of this first session is a lot of definitional activity. In practice, feel free to talk during the break to people who have been doing this for a while. I don't mean to scare you. We may have some unique circumstances, but we can work through those. I just want to make sure you're prepared because the certification test may ask a couple of these unique elements. You will have access to all resources. This is an open book test. You are happy to use any resources. You don't have to memorize anything. But why don't we take a 5-minute break here before we head over into our filing status. And if you have any questions, I'll be around here as well. All right, we'll probably get back together here in just a minute. Hopefully we're making sure everyone's well caffeinated, well sugared. We're about halfway through the presentation. And for those of you whose minds are swimming in the world of dependency, I just want to preface this by saying the good part is that the dependency rules really aren't going to be triggering a lot of different tax consequence. So we had some questions about what if I mischaracterize someone as a qualifying child rather than a qualifying relative? Did I mess up something on the return? Well, what we're going to talk about a little bit later in this series is the credits that arise from taking dependency. So while we're taking a look at who you can claim on the return, that's going to trigger a couple of the other benefits I mentioned. The ability to take a head of household or maybe changing that filing status, the ability to take the credit for child independent care benefit, the child tax credit. Those are all predicated on other factors. So when we take a look at claiming another relative on the return, that other relative position, that could get to a $500 credit on the return. So, but if you have a child who's older than the child tax credit, they'll also be considered that $500 credit. So I'll mention that again as we get to the credit portion. But just want to make sure that as you're taking a look here, I don't want anyone to get overly confused on the dependency rules. We're just trying to determine, can they be on the return? And if so, what category would they be in? What that's going to do is allow you to see the front page of the 1040, and they'll all be listed there on the return. And as long as that individual, when they file their return, puts they are dependent of another, the return should be e-filed. I do have the benefit, I work with a lot of Amish clients, so generally when we see dependents, it says see attached on page 1. And we have to keep track of all of those individuals because good news is I don't believe we have a whole lot of Amish clients coming into the VITA sites. I don't think anyone, even down south, I don't think we have a lot coming in kind of the Lampeter-Strasburg area. Not a buggy tie-up at any of the sites at this point. But it does get a little unique when you see 15-year-olds who are already done with school making $70,000 a year in construction and trying to determine whether or not they are still considered a dependent. So good news is not on the exam. The IRS is not dealing with the Amish, and hopefully you don't have those in your sites as well. But those are some interesting issues we take a look at. Again, the materials that you have are going to be great to follow along. We'll have some flow charts. We'll have some other decision trees to work with. If you have questions at the site, your site coordinator is going to be your best resource for that. I'm trying to get you ready when you take a look at the exam. Read it, the questions multiple times to try and figure out what they're asking, because the questions are not, they're written about as well as the tax code, about what they're asking for here. So just suspend your knowledge of English and how things should be written, and hopefully it'll go a little bit better. Maybe do it when you're drowsy and you're not comprehending things very well, because then it makes sense. But we'll talk a little bit more about kind of getting ready for the certification exam as well. Okay, any other questions on dependency before we move on to filing status? Hopefully this is going to be a little bit more straightforward. Okay, so let's talk about the filing status. On the 4012, again, hopefully this will be on B13 and B14. It sounds like I'm calling out bingo here. Always great to be here in a church and talk about B13s. But we're going to talk about the 5 filing status, or status I. I still haven't figured out how to grammatically pluralize that. But we're going to have 5 different options you have for filing status. And again, that's going to trigger whether or not the individual needs to file a return. We'll talk about the 5 ones being single, married filing jointly, married filing separately, head of household, and qualifying surviving spouse. The very first one that I want to mention is single. Now, what we're going to take a look at here, it's literally looking at the last day of the year. December 31 will be our litmus test as to your marital classification. If on the very last day of the year you are unmarried, under PA law we don't have legal separation, but other states could have a legal separation, or you're divorced. So at the very end of the year, December 31, are you not married? That's basically our question. This is not taking a look at your Facebook status to say it's complicated in a situationship, anything along those lines. It's literally, are you married as of the last day of the year? If you are not married at the last day of the year, you are single. And basically, that would be our default position. You may qualify for another one. We'll talk about some other options here. But we're basically looking at the very last day of the year, are you married? And hopefully the answer is, I don't know. Hopefully people have a good understanding of whether or not they're married. If the divorce has not gone through here in PA, you are still married. That's a fairly straightforward position here in PA. We do have a number of people who come in and you ask, are you, what's your relationship status? Are you married? Yes, I'm married. Okay, and can you tell me a little bit about your spouse? Well, my spouse died in 1974. So sorry for your loss. You are not considered married for the tax code. If your spouse died before the prior year, you are going to be considered single, unless another provision applies. So single is anyone who is not married as of the end of the year. Now, the next situation, what happens if you are married at the end of the year? So if you are married at the end of the year, we have a couple different options. You can be married and living together. You can be married and living apart. You can be in a recognized common law marriage. Again, we don't really have that here in PA. But the situation is, if a couple comes in and says they're married, we generally go under the presumption they are married. So we don't need documentation. You don't need to get a copy of their wedding album, or if they still have the top of their cake to bring in to share with you. If they say they're married, we generally go with that presumption. If they tell you that they're married, but they want to file as a single, now you've just stepped in a whole different situation. If you tell us you're married, we're going to assume that you're married. You can't change your answer later and go through that process. But if you're legally married as of the end of the year, then we're going to treat you as a married couple. So you can file jointly with your spouse. You can also file it jointly if your spouse died in the current year. So if they passed away in the current year, you can still file jointly with your spouse, as long as you meet one of those other tests. Now, I always have to say this. I've yet to see this happen. If you are married in the year and your spouse dies, you can still file it jointly with him, unless you remarry in the same year. If you remarry in the same year, then you're going to file jointly with the new spouse. The old spouse is now going to file, their deceased one's going to file married filing separately. So we normally don't see that situation. If that's going to occur, most likely that's going to be on Dateline, where someone has passed away and their new spouse is married within 3 days to someone else. That's probably the insurance is going to take a look into that and a whole bunch of other issues. I have yet to see that, but that would be the technical answer if someone remarries when their spouse dies in the current year. That's a pretty quick relationship change there that would be a little unusual. There is another option for married filing separately. Again, as you saw with the chart, we don't recommend this because in order to have a filing requirement, all you need is $5 of income if you're married filing separately. You can choose to file separately. We do have people that come in and say, I'm married, but I don't want to file with my spouse. Do want to mention, we are not marriage counselors. So we're not going to get in the situation of why are we not filing together, that they're having a separate appointment to come in, they don't want to speak to each other. That is perfectly fine. If they're married at the end of the year, their options are married filing jointly, married filing separately, maybe we'll get them something else. But we sometimes have people come in, and I have clients that say, I can't file a joint return with my spouse because they have a tax lien, that the federal government's going to take our entire refund because they have some past tax liabilities. They owe child support. They have other things occurring. We have some solutions. There's a couple different things that could occur. But one of the main things we hear is people don't want to file a joint return because it's joint and several liability. That if the IRS comes back and wants more money, they could go after either party. That's what they mean when you file a joint return. But we have a couple exceptions, both of which are available here within VITA. One is called an innocent spouse relief, and one that is probably a little bit more well known, where if you are filing a return and you've signed off on the return and it turns out that your spouse has done something that you were not aware of. Yeah, we may have people come in and say, I don't trust my spouse. Again, not marriage counselors, so that's a whole different situation. And we don't have a whole lot of individuals coming in with self-employed businesses. But if someone comes in and says, my spouse is going ahead and they're reporting that they made $5,000 in construction activity last year, but we have 3 homes, we travel for 6 months out of the year, and I've never had regular rice. I only know what risotto is. You probably have an indication that that return is not accurate. That if there's a whole lot more money than you see than $5,000 a year in net income, you're no longer considered an innocent spouse. If you have no knowledge, that's a different situation. Again, we don't really see innocent spouse too much. We'll have some options for people that are in that situation. We'll probably refer them out to Mid-Penn Legal Services to take a look at innocent spouse. The one that I work with a lot more is what we call injured spouse. An injured spouse is that situation where one of the taxpayers has an outstanding federal obligation, whether it's past tax balances they have. Usually I may see it with maybe a garnishment like child support, or more importantly, maybe student loans that they're going to take the refund from. It gives you the opportunity. It's called an injured spouse. It's a Form 8379. You can actually complete it within VITA. I do that with a couple of individuals I work in the tax layer program with. And it allows you to allocate the refund between the 2 spouses. If we do not file jointly, we're going to lose a lot of benefits, and I'll go over that in the next slide here. In very, very limited circumstances would it make sense to file separately. Most cases would probably not make sense. So the injured spouse is probably a good, viable solution. The form is very easy to go through. You separate the income, you separate the withholding, you separate the deductions. And what they're going to do is the injured spouse is still going to get their share of the refund. They're going to basically take whatever was allocated to the spouse that owed past tax liability. That's the only amount of refund that the IRS is going to take. So it's a very good solution. So why would we not want to file married filing separately? Just a couple things that are negative impacts. Lost or limited credits. Earned income credit doesn't apply if you're married filing separately. Credit for the elderly, not a huge one, but the child care credit, adoption credit, and the education credits are all gone or significantly limited if you file separately. You don't get the student loan interest deduction if you file separately. You don't get the savings bond exclusion. Your standard deduction goes all the way down to $5 because if one spouse itemizes deduction, the other one has to as well. So that's why we see a $5 filing threshold for married filing separately. Greater percentage of your Social Security is taxed. You're actually going to be taxed at a higher tax bracket. You'll lose some other benefits here as well. So have we mentioned that it's not a good strategy at times to file separately? Okay. There are some ways around it. Again, we have some solutions that are available, and hopefully we can come up with a reasonable solution. Married filing jointly is generally always going to be better than filing separately. And if they have concerns about their refund being reduced or whether their spouses, they don't fully trust them, we can come up with different options. Yes?
One thing tax layer will do is a comparison showing you married filing jointly separately. Now some of every time.
Perfect. Great. So the comment was that TaxSlayer will actually have a comparison between filing jointly and filing separately. And again, I don't think we'll see many situations in TaxSlayer where separately is going to be more advantageous than jointly. So the software is going to automatically do that. So if someone says, should I do it differently? I have a number of my clients that ask that, and I can produce the same report with my program, and it really generally helps out why we don't want to file separately. Okay. How are we doing so far? Singled, married. Seems pretty clear cut. Guess what? We have 2 more to go. So let's take a look at the next one. Okay. This one is the one that everyone would love to get into, the head of household. You may get the client coming in and saying, hey, my neighbor down the street just got done telling me about the head of household and how that was so advantageous for their tax position. I want one of those. I feel like I'm the head of my household. I get to determine what we get to eat. I do all the laundry. I should have full control of the remote control to watch my programming at night, and I want to be head of household. Okay, that's fine. But there's a couple specific rules we need to take a look at. Again, each tax year is going to stand on its own. So just because last year someone was head of household does not mean they necessarily qualify for this year. We want to take a look at these rules. Now, the biggest one, they have to be a U.S. citizen or resident for the entire year. So I know we have a couple sites where we have some people who are non-residents or maybe some immigrants coming in. They have to be a U.S. citizen or resident for the entire year to become head of household. So that's one of our first criteria. Now, this is what gets unique. They are either not married at the end of the year, which we just covered with the single definition, or considered unmarried. Well, this is a whole new another terminology here. What is considered unmarried? And I'll review that in the next slide here. They have to pay more than half the cost of keeping up a home, which hopefully head of household makes sense. They have to keep up more than the half the cost of maintaining the household. And the household has to be the principal residence for more than half the year for either a qualifying child or the qualifying relative. A couple exceptions, but this is the reason we do the dependency test before we do the filing status. So at least you have an idea of what it means about a qualifying child or qualifying relative. So generally the individual needs to live with you in order to get head of household. There is an exception. If you're claiming a parent on the return, your parent does not need to live with you to be a head of household. So that parent could be in a facility, that could be an outside home. You can still take head of household even though they don't live with you. That's the only exception to someone living with you. Other than that, they have to live with you for more than half the year. Also, the exception is we just got done talking about a cousin of yours living on your couch for the entire year. Downside, they're not going to get you head of household status. They can get you a qualifying relative, but they're not going to be considered a head of household opportunity. They actually have to be a true qualifying relative. So what we're looking at is maybe a single individual that is maintaining the cost of a home for more than half the year for themselves and either their children or dependent parents, or we may have a considered unmarried. So this is where a taxpayer is going to file a separate return. Generally, we may see this in the process of a divorce, where someone may be going through a divorce proceedings. It's not finalized yet, but they can be considered unmarried if the following circumstances occur. They're not going to file a joint return together, that the individual has paid more than half the cost of maintaining the home for the year. The spouse did not live with them for the last 6 months of the year. So again, generally a situation might be that someone's going through a divorce, the people have already separated, that spouse is no longer in the home. So a couple dates to keep in mind. July 1, make sure they're out. Don't have them come back. If you invite them for Thanksgiving, make sure they stay and leave before they fall asleep after having too much turkey. They do not come back to the house. If they're out of the house for the last 6 months, we're in good shape. So now you're technically married, but we may be able to get you to a head of household status. As long as the home is the home for more than half the year for your child, stepchild, adopted, or foster child. Grandchildren do not count for this considered unmarried. So I just want to make that clear. Grandchildren cannot consider you unmarried. It has to be your own child, foster child, stepchild, or adopted child. Again, this can actually work too, even if you've released that child dependency, as we talked about, to the non-custodial spouse, you can still be considered head of household. So we're looking at where the child spent more than half the time. That can get you to head of household status. Now, the question may be, what if we have spouses that are separating, they both have their own individual place, and they have multiple children? Well, that's fine. They could both be head of household as long as they're each claiming a child on the return or eligible for the child. Again, it technically is revolving around custody. So as long as they have more than the child for more than half the year, they should be in good shape. But we can have both people be head of household. The question, I think, John, you mentioned about what if we have unmarried parents? Well, unmarried parents living in the same household, only one person could be head of household. We can't have multiple people being head of households of the same household. Only one person is paying more than half the cost of the home. And when we take a look at those definitions, fortunately we have a couple charts that'll work through that. Hopefully it stays on B16 of your 4012. The costs we have that would help determine if you're paying more than half the cost are things like rent, mortgage interest, real estate taxes, utilities, property insurance, repairs and maintenance, any food consumed inside the home. This is kind of a tricky subject because when we first started these definitions, we did not have DoorDash. They initially presumed this to be groceries, someone buying food and preparing it and making it in the home. I don't know what that means if the kids want KFC and they want it delivered. Well, we're not eating at the restaurant now. Now it's kind of getting delivered to the home. So hopefully we don't have to get to that level of minutia here in the determination. But any other household expenses. This does not include things like food, it does not include clothing, travel, medical costs, that type of thing, education. It's purely for the cost of the home. Anything under the roof, utilities, maintenance, all that other good stuff. There is actually a chart that not only is in your text, but also the IRS will use as well. So when we have a question, do they provide more than half? The way the IRS is going to settle this is they say, all right, here's a listing of what we have. We're going to put the amount that you paid versus the total amount. We'll do simple math. If your amount is more than half that amount, you get it. If it's less than half the amount, you're not considered as providing more than half the cost of a home. So the main takeaways, we get people who want to go ahead and claim head of household. It's generally going to be a situation where they're unmarried, but they have a dependent child at home. They're providing more than half the cost of the home, and the child's with them for more than half the year. You can also have that for people who are in the process of a divorce that are considered unmarried. Okay, so I just want to make clear where traditional those are coming from. Does anyone else have any examples of head of household that arise in a different circumstance? Yes, sir. Or a question as well. That's fine too.
question. So
Yeah.
you only have one head of household per address, is that?
Generally, yes. The question is, can you only have one head of household per address? In general, that would be the case. So one of the ways the IRS can identify this is by taking a look at how the head of household and the address on the return. If you have, 913 Walnut Street and you have 5 people claiming head of household, there may be an issue. If they're separate units, maybe you have an A and a B or first floor, second floor, if they're separate units, we could still have that to be occurring. But if you have a situation where you have unmarried people living in the same household, only one person's paying for more than half the cost. So it's not just 50%, it has to be more than 50%. So we just have to be cautious in that scenario. Have people claimed head of household status for more than one property? Absolutely. Is it permissible? That's for the IRS to determine, but generally no. Only one person can generally be providing more than half the cost of the home. Okay. Yes?
How does a parent who doesn't live in a house qualify for this? I mean, I guess they're qualifying relatives that live in a home, let's say, 50% or something.
Sure.
They can still use them as you can still pay that house.
Correct. So the question is, if you have a parent who's not living in your home, that's the one exception we have for having to be in the home for more than half the year. So the government's aware that you may have a situation where a parent may not be living at home due to other circumstances, whether they need more nursing care or something along those lines. So that's fine. They don't. The only exception we have to living there for more than half the year, or the custodial parent issue, is your own parent, your mother or father who's not with you. That will still allow you to take head of household because you're providing more than half their support. But again, we have to take a look at that context too. They would be a qualifying other relative, so you would need to still provide more than half their support.
And their Social Security.
Right, so their Social Security income, we'd go back to that test for the, yeah, so back to that 5,200 gross income category. Now, we may have to take a look at other things. Do they have things like long-term care insurance that are paying for their stay or their other benefits there? So I don't know, we see it all that often here within VITA, but I just want to make sure you understand the rules are you can take a parent as head of household even if they don't live with you. But I think the majority of the ones that we're seeing are probably going to be single parents or people maybe going through a divorce and considered unmarried. Any other scenarios that I'm missing? Yes, sir. I'm sorry?
Incarceration.
Incarceration, yep. So someone may not be there because of incarceration. That's so they may still be technically married, but they're not in the home for the last 6 months of the year. Yep. So it doesn't have to necessarily go through the. Yes. Yeah. Yeah. Or it could be a little while. Yeah. Okay. So again, head of household. Yes. I'm sorry. Yes.
Just a clarification, your thing up here is cost of keeping a home.
Yes.
But that's different from the actual support.
Correct.
So the support includes clothing, education.
Correct.
Not the cost of keeping a home.
That is correct. So in order to get to this stage, we need to jump through two steps. One is they have to be considered a qualifying relative, meaning you provided more than half their support. So that's going to be a qualifying relative. And then we have to go to the actual cost of the home. So in the first scenario, we're including all the food, clothing, all the other things. When we get to the cost of the home, we get rid of all the clothing and everything else. It's just the cost of maintaining the home. Yep, absolutely. Okay. Again, head of household, a lot of people want it. The main difference we see is really just an increase in standard deduction and maybe a little bit of difference in the tax rate. It's not a huge difference. And you brought up a great point about maybe showing different scenarios. If it's close, you can say, all right, let me just switch your filing status between single with dependent children and head of household. If you have multiple people trying to claim head of household under one jurisdiction, I've run scenarios and say, okay, what can we do here? One of you is going to get a better benefit than the other. I can't take both of you to have head of household. If you're unmarried and you're in the same household, I'm going to make one of you single and one of you head of household. But I'll take an extra couple minutes and run the scenarios 2 different ways to find out which one's going to be better at taking the head of household. We don't want to spend all day saying, okay, the permutations of going through and saying, okay, single versus head of household, how many kids do you take? But we do have some options. We do have some flexibility. Again, the main thing we want to have the returns be correct, getting to the IRS. As long as we don't have multiple people claiming head of household for the same jurisdiction, we should hopefully be okay. Okay, you ready for the last one? Okay, qualifying surviving spouse. This one is the most rare of all the status because what we're looking at, very, very specific facts and circumstances. One is your spouse has passed away, but in the prior 2 years. You also have to have the ability that you filed a joint return the year the spouse had died. You did not remarry before the end of the tax year. So in 2025, we're going to make sure they did not remarry. You're paying for more than half the cost of maintaining a home. And it also has to be the primary residence for the dependent child or stepchild for the entire year. Not more than half, it has to be for the entire year. Again, grandchildren and foster children do not count. So this scenario is generally where you have a premature death of an individual, the spouse has not remarried, and they're still maintaining the cost of the home for their children. I have run into this situation before. I unfortunately have a Amish client who had died in a farming accident. Wife did not remarry. She still has, as you can probably tell from the Amish community, several children that are still living with them. So about eight dependents, I believe, and that one I still try and keep them all straight. But let's go through a quick scenario. So we have an individual who dies in the current year. What would our filing status be if you're married and your spouse dies in the current year and you don't remarry? Married filing jointly, or that would be our primary consideration. What happens in the next 2 years? Spouse died, you have dependent children. For the next 2 years, you can claim qualifying surviving spouse, provided you didn't remarry. The benefit with this filing status is it keeps you at the same standard deduction as married filing jointly. That's our main benefit. You're going to go and still do the same benefit of standard deduction. Now, what if our scenario is if the taxpayer died in 2022? So the year they died, we can file jointly. The next 2 years, we can file a qualifying surviving spouse. But here we are now more than 3 years after the date of death. Had a household, perfect. So that's our next option. Single individual, considered not married, but maintaining the home for more than half the year for her dependent children. So those are the different characteristics we have. We can always still file single, but that's not the most advantageous. So I just want to go through a couple of those scenarios with you and make sure that they're clear a little bit on how we want to address those. Okay. How are we feeling on those areas? Okay. We're going to finish off with just a couple of unique filing situations. And again, a lot of these are going to be some activity we just want to kind of mention here specifically for our VITA and how they're going to be applicable. So we do have a lot of refugees and other people from outside status coming in here to the county. It's a great community for people to bring others in, especially for refugee status, and we do provide return services in certain circumstances. So the one thing we want to take a look at, I just want to kind of give you a quick overview of resident versus non-resident alien. So what we take a look at is determining whether or not an individual is considered a resident alien or a non-resident alien. That's going to determine their filing status. We have to go through a couple rules and also how we need to file that return. There are a couple taxpayers here on specific visas, the F, J, M, or Q. These are generally going to be student visas or teaching visas. Those are going to be outside of scope for VITA. So we typically will not do those within the VITA program as a matter of course. But we do take a look at this resident versus non-resident alien. So a resident alien is treated just like a U.S. citizen. They're going to still file the Form 1040. They're actually going to be taxed on all their income from worldwide sources, but they're going to get the same filing status, the same dependency rules that we just covered today. Non-resident aliens, if they didn't meet the test, would file a Form 1040-NR, which the government doesn't know how to define a child, but they do know how to abbreviate pretty well. So the NR stands for non-resident. So that's what the 1040-NR is. These are typically going to be some of our maybe refugee students and things like that that are not actually on the path for residency. So they're non-resident aliens. Those are outside the scope of VITA as well. So where we can actually take a look here are resident aliens. So that is actually hopefully still on L6 of your 4012. So the biggest one we have is a green card test. If the individual is holding a green card, they're not actually a U.S. citizen, but they're considered a U.S. non-resident alien. And that would allow them to be legal permanent lawful residents in the U.S. I'll give you a hint. The card is no longer green. So while they call it a green card, don't be looking for, if they give you a document like, I can't take this, this is not green. It's still okay. If they hand you a document that's green and tell you that's their green card, that's also not a legal document. So don't just, if it's an index card they found and they wrote legal alien on here, that's not valid. So most of them know what their immigration status is. So they will have a document from the government saying that they're a legal U.S. resident. That's a green card. The other thing we can take a look at is something called a substantial presence test. That's also found on L6. It basically takes a look at how many days are they physically present in the U.S. Typically, for our site, we will not do this for the first year that they're here because we need a cumulative amount of days that they're here in the U.S. to be substantial presence. But the chart is available if you want to take a look at it. I believe there's a couple sites that probably have a little bit more activity with resident aliens than others. If you do get one of these, again, make sure it's to your certification level. And if you have any questions, be sure that we get those to the appropriate party. But substantial presence is really just taking a look and making sure that they meet the requisite number of days here in the U.S. Yes?
If they have a green card, do they still need to go through the substantial presence test?
They do not. This is an either or. So if they have a green card, they're automatically considered a U.S. resident alien, which puts them back on the Form 1040. They do not have to go through substantial presence. Usually substantial presence is as you're going through the immigration process. They haven't been issued a green card yet, so we can still determine they might be here. It might be a situation where you may have someone who's married an individual and they haven't gotten the green card yet, or they haven't applied for immigration. So that might be or they're in a transitory nature, maybe they're permanently relocating as a refugee. So that would probably be substantial presence. Okay. Oh, yes.
Is a substantial presence test, these people have to be on a path to citizenship?
They don't necessarily have to be on a path to citizenship. They just have to be substantially present. Most likely, they probably are on a path to citizenship, or they have some sort of relationship here in the U.S. What it might be is, one, the scenario you mentioned, on a path to citizenship, or maybe they are a citizen of a foreign country and they're here with their spouse. Maybe they're not necessarily intending on changing their citizenship, but they're substantially present here enough that we can file a U.S. return for them. It cleans up that situation a lot more if they're considered a resident alien. Yes?
The green card is minimum wage.
Oh, that's a great question. I should probably Google that one at some point, but yeah. So I imagine at one point it was green, but my knowledge on immigration laws is a little limited, but yes.
What are the nuances of a social security card that says for work only?
Yeah, that's a great point, Mike, and that will be our final slide of the day here on tax identification numbers. So I'm glad you brought it up. Just to let you know, we did not agree to that question in advance, so in case you're wondering, the impeccable timing we have here, this is a perfect setup. But just want to talk a little bit about identification numbers. So generally, all of our individuals coming into our site should have a social security card. That's our primary measure of getting the returns prepared. They can have something called an ITIN, which is a individual tax identification number. It's effectively on the pathway to getting a social security number. There's also an ATIN. We don't see many of those. That's an adoption tax identification number, generally assigned when someone's in a process of an adoption. Generally, a foreign adoption is taking a little while to go ahead and get that finalized. But to Mike's point, there may be a situation where someone may have a card that says valid for Social Security purposes or valid only work within the U.S. Again, this may be on your certification test. This is taking a look. We may have an ITIN. So that's the official one that's going to be issued from the government. So they'll actually have, instead of a Social Security card, they'll have an individual tax identification number. We want that one to be the primary number on the return. They may be getting W-2s that have a different number on. And that's okay. We're going to report the W-2 exactly as shown. But the primary number on the return has got to be the ITIN. The W-2 that they have on that, the Social Security number, the W-2 is not correct. But if they have a Social Security card that says valid for work only with INS or DHS authorization, then they may be able to claim the earned income credit. If they don't have that, if they don't have a Social Security number, they're not going to be eligible for the Earned Income Credit. Also, just a quick point here, if you have an individual who may be here, maybe they lived here and they have, they brought family members over with ITINs, the individual tax identification number, the ITIN will not allow an individual to take the child tax credit. So you can only take a child tax credit with the Social Security number. So if you have someone who's coming in and maybe they're in different levels of kind of getting their immigration status, the parents may have Social Security numbers, that's great, the children don't have them yet, we cannot take the child tax credit. Before you say, oh, you can't get anything, you can actually get the credit for other dependents. So you may not get the full $2,200, but at least you can take the $500 credit for other dependents with an ITIN. So just want to give you a couple different elements there. Yes, Mike?
It says for work only.
Yeah.
You don't do the return under that Social Security.
Correct, right. That's correct. If they bring a card and it says valid for work only, that's only so they can generate a W-2. That's not actually for the true.
And have an ITIN.
Correct. They should have an ITIN that's going to be what we generate their return from.
It could still be a non-resident alien.
Yep, they could still be a non-resident alien. Generally, that's where we're probably going to see it. The non-resident alien is going to have the ITIN, and then the W-2 is going to be effectively a number just given to them by Social Security as a temporary process. So it probably will just enter the W-2 exactly as shown. We may need to do a quick modification, but the ITIN should be the primary number on the return. Okay, yes?
Question. What happens when, say, a spouse has been here for the whole year and worked and has the ITIN and everything, and then their other spouse finally gets here, say, in November or December, and looks a little bit? Does that still, would that not qualify then for those credits, or do you do one of those married filing separate things, or how do you do that?
Yeah, that one becomes kind of a unique situation. So we may end up doing, you could do a married filing separately return, but then again, you lose a number of these benefits like the EIC and all kinds of other things. So there may be a couple exceptions we'll take a look at of how we want to address that situation. If you have an individual here and their spouse is coming in, or maybe their spouse is still abroad. If they can consider themselves to be a resident alien, we may have some options that we can work with on that return. So we can take a look at that very specifically on those returns. If you have the questions with those, feel free that we'll pause the return and make sure we get the best filing status possible. Absolutely. Okay, so that's effectively what we wanted to cover here this morning. Again, I hope to see all of you back next week. I hopefully didn't scare anyone off here. Again, for those who are returning, there's not a whole lot of new changes. It just always sounds weird every time I go through it, explaining the technical rules of the IRS. We'll get a lot more exciting as we talk about income next week, and then the following week we will not be here because it's Thanksgiving, but then we'll come back and talk about deductions and credits, which is the fun part about VITA. But if you have any questions, I'll be around for a little bit, but enjoy the rest of your day today. And we'll see you back hopefully next week at the same time. Thank you very much.